Thank you, Mr. Chairman. And I also want to say thank you, Mr. Chairman. This has been my first chance to say in public how grateful I am for your help in setting up the consumer agency and how helpful all the people were at the Fed during the time of transition of the consumer function. So thank you very much. I'd like to go to the question about too big to fail, that we haven't gotten rid of it yet. And so now we have a double problem, and that is that the big banks, big at the time that they were bailed out the first time, have gotten bigger, and at the same time that investors believe with too big to fail out there that it's safer to put your money into the big banks and not the little banks, in effect creating an insurance policy for the big banks, that the government is creating this insurance policy, not there for the small banks. And now some economists, including an economist at the IMF, has started to document exactly how much that subsidy is worth. Last week, Bloomberg did the math on it and came up with the number $83 billion that the big banks get in what is essentially a free insurance policy. They borrow cheaper than the small banks do. So I understand that we're all trying to get to the end of too big to fail. But my question, Mr. Chairman, is until we do, should those biggest financial institutions be repaying the American taxpayer that $83 billion subsidy that they're getting?
Well, the subsidy is coming because of market expectations that the government would bail out these firms if they failed. Those expectations are incorrect. We have an orderly liquidation authority, and even in the crisis, we, in the cases of AIG, for example, we wiped out the shareholders.
Excuse me, though, Mr. Chairman, you did not wipe out the shareholders of the largest financial institutions, did you? The big banks?
Because we didn't have the tools. Now we could.
Well,
now we have the tools.
$83 billion says that, whatever you're saying, Mr. Chairman, $83 billion says that there really will be a bailout for the largest financial institutions if they fail.
No, that's the expectation of markets, but that doesn't mean that we have to do it. I think we have to do is solve the problem, Senator. I think we are really in agreement on this. Too big to fail is not absolute. There are spreads. Their credit default swaps say there is some probability of failure. Moody's and others have downgraded these firms. They've taken down some of their government support ratings, as you know. But we have a lot more to do, I agree. And I think that's a good debate to have. But we're in complete agreement that we need to stop too big to fail.
But I don't understand. It is working like an insurance policy. Ordinary folks pay for homeowners insurance. Ordinary folks pay for car insurance. And these big financial institutions are getting cheaper borrowing to the tune of $83 billion in a single year, simply because people believe that the government would step in and bail them out. And I'm just saying, if they're getting it, why shouldn't they pay for it?
I think we should get rid of it.
Well, all right, then I'll ask the other question. You were here in July, and you said that you commended Dodd-Frank for providing a blueprint to get rid of too big to fail. We've now understood this problem for nearly 5 years. So when are we going to get rid of too big to fail?
Well, some of the, as we've been discussing, some of these rules take time to develop. The Orderly Liquidation Authority, I think we made a lot of progress on that. We've got the living wills. I think we're moving in the right direction. If additional steps are needed, then Congress obviously can discuss those, but we do have a plan, and I think it's moving in the right direction.
Any idea about when we're going to arrive in the right direction?
It's going to take. It's not a 0-1 kind of thing. It's over time. You'll see increasing market expectations that these institutions can fail. And I would make another prediction, and predictions is always dangerous, that the benefits of being large are going to be small, are going to decline over time, which means that some banks are going to voluntarily begin to reduce their size because they're not getting the benefit that they used to get.
I've read you on this. I read your predictions on this in your earlier testimony, but so far it looks like they're getting $83 billion for staying big.
Well, that's one study, Senator. You don't know whether that's an accurate number or not.
Well, okay, we'll go back and look at it again if you think there's a problem with it. But does it worry you?
Of course. I think this is very important. And I think we need to, and we're putting a lot of effort into this. It's a problem that we've had for a very long time, and I don't think we can solve it immediately, but I assure you that as somebody who spent a lot of late nights trying to deal with these problems in the crisis, I would very much like to have the confidence that we could close down a large institution without causing damage to the rest of the economy.
Fair enough. I know we're both trying to go in the same direction. I'm just pointing out that in all that space in between, what's happening is the big banks are getting a terrific break, and the little banks are just getting smashed on this. They're not getting that kind of break. And that has long-term impact for all of the financial system.
I agree with you 100%.
Thank you.